Good evening, investors. Welcome back with me, Madhveshwari on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia struggled to regain its footing by mid-afternoon on Monday as escalating geopolitical tensions in the Middle East dampened investor sentiment across the region. Despite paring some of its steeper morning losses, the benchmark index remained firmly in the red, rejecting a cautious global mood. By 3 p.m., the FBM KLCI stood at 1,702.93, down 13.68 points from Friday's close. The index had faced a rocky start to the session, opening significantly lower and hitting an intraday bottom of 1,684.28 before a slightly recovery effort took hold. The broader market sentiment was decidedly somber. Decline has dominated the landscape, with 1,006 stocks losing ground compared to only 248 gainers. Market activity saw a turnover of 2.60 billion shares, valued at approximately 2.36 billion ringgit. Performance among the market's heavyweights was a mixed bag. Banking giants faced pressure, with Maybank dropping 20 cent to 11 ringgit 76 cent and Public Bank shedding 7 cent to 4 ringgit 86 cent. However, some blue chips managed to defy the downward trend. Hong Leong Bank surged 42 cent to 23 ringgit 70 cent and Press Metal advanced 12 cent to 7 ringgit 25 cent. In the mid-cap of retail space, energy-related stocks provided a rare bright spot as oil prices reacted to global instability. Hibiscus Petroleum jumped 24 cent to 1 ringgit 84 cent, while Valesto edged up 1.5 cent. On the flip side, consumer and tech stocks took a heavy hit. Nestle led to decliners, tumbling 2 ringgit to 107 ringgit 90 cent, followed by Malaysian Pacific Industries, which fell 1 ringgit 18 cent to 30 ringgit 78 cent. Sector-specific indices told a tale of two markets. The financial services and plantation sector suffered notable declines, falling 160.37 points and 67.80 points respectively. Conversely, the energy index rose 8.10 points, buoyed by the rising profile of oil and gas counters amidst the international friction. As the trading day progressed, the FBM Mass Index and FBM 70 Index both recorded triple-digit losses, signaling that the sell-off was widespread across various market capitalizations. Investors remain on high alert as they monitor developments in the Middle East, which continue to dictate the rhythm of risk appetite in Kuala Lumpur. Now for some local economic news updates. The Malaysian ringgit has seen a significant appreciation, rising 4.31% to 3 ringgit 89 cent against the US dollar as of early March 2026. Finance Minister Datuk Sri Amir Hamzah Azizan attributed this strengthening to the nation's robust economic performance in 2025, where the gross domestic product growth of 5.2% comfortably surpassed the government's initial targets. Speaking at the Dewan Negara, Amir Hamzah noted that the economic momentum was particularly visible in the fourth quarter of 2025, which saw a growth rate of 6.3%, which is the highest in these 3 years. This surge was primarily driven by resilient domestic demand and broad-based expansion in the manufacturing and services sectors, which helped the country exceed its original forecast range of 4.0% to 4.8%. During his winding-up speech on the royal address, the ministry stated that this growth is supported by expansion across sectors, particularly services and manufacturing, with domestic demand remaining the main driver of the economy. Beyond domestic factors, the ringgit's recovery was bolstered by a shifting global landscape. Amir Hamzah pointed to the US Federal Reserve's move to the lower interest rates and the general expectation of a more accommodative monetary environment among major economies and key catalysts. These external factors, combined with steady inflows of foreign direct investment and portfolio capital, have significantly improved investor sentiment toward Malaysia. The minister also emphasized that political stability has been a cornerstone of this economic success, allowing the government to implement long-term structural and fiscal reforms with confidence. These reforms, he argued, have played a vital role in convincing international investors of Malaysia's sustainable growth trajectory. He added, clearly, with a stable politics, economic policies can be implemented clearly and sustainably, reinforcing the link between governance and currency performance. Still on economic news, the recent military escalation in the Middle East sparked by US and Israel strikes on Iran has triggered a significant wave of economic and diplomatic ripples across Malaysia. Financial markets reacted sharply on the first trading day of March, with the FBM KLCI plunging below the critical 1,700 point support level, while banking stocks suffered heavy losses due to fading risk appetite. Energy-related counters like Petronas Dagangan and Hibiscus Petroleum surged alongside global Brent crude prices, which jumped over 7%. Economists and government officials, including MIDA Chairman Tengku Dato Sri Zafrul Abdul Aziz, have warned that the conflict poses a dual threat of cost-push inflation and logistics disruptions. Airspace closures have already forced Malaysia Airlines to divert flights, leading to higher fuel costs and potential cargo delays. Tengku Zafrul noted that a prolonged conflict could make imports significantly more expensive, especially as investors flee to safe haven assets like the US dollar, putting further downward pressure on the ringgit. When routes are unsafe, flights have to be diverted or cancelled. This means longer flights to Europe and increased fuel costs and risk of their cargo delays, Tengku Zafrul explained, highlighting the immediate strain on the nation's supply chains. The instability has also prompted immediate diplomatic precautions. The Malaysian embassy in Abu Dhabi has suspended in-person consular services, moving operations online to ensure the safety of staff and citizens amid the ongoing regional security situation. While the embassy remains reachable for the emergencies, the move underscores the heightened state of alert for Malaysians residing in the United Arab Emirates. Despite the turbulence, some analysts remain cautiously optimistic. Experts from CIMB and Bank Muamalat suggest that if the conflict remains contained, the long-term impact on Malaysia's GDP and fiscal position may be limited. However, the government continues to monitor the situation closely, balancing the benefits of higher petroleum dividends against the rising cost of domestic fuel subsidies and the potential for stagflation, risk exported from the global markets. Up next, we have some corporate updates. KJT's Group Berhad has announced that its Huawei-owned subsidiary, KJ Technical Services Sidrian Berhad, has clinched a 13.5 million ringgit contract for specialized engineering works in Kuala Lumpur. The contract awarded by BPL Engineering Sdn Berhad focuses on the provision of air conditioning and mechanical ventilation services for the Chengdil Specialist Hospital. According to a filing with Bursa Malaysia, the comprehensive scope of the project involves the demolition of existing unused air ducts and related ACMV equipment. Following this clearing phase, KJ Technical Services will be responsible for the supply and installation of modernized air conditioning and mechanical ventilation system tailored to the hospital's clinical requirements. The project is already underway, having officially commenced on January 29, 2026. The group expects to complete the installation and ventilation works by September 28, 2026, marking an 8-month turnaround for the healthcare-related infrastructure project. The company stated in its regulatory filing that the job scope includes the demolition of unused air duct and air conditioning and mechanical ventilation related parts of equipment and the supply and installation of air conditioning and mechanical ventilation related works. This latest win adds to KGT's Group's growing portfolio of technical services contracts, further solidifying its presence in the specialized building services market. The successful execution of the Changgil Specialist Hospital project is expected to contribute positively to the group's earnings for the 2026 financial year. And finally, wrapping it up with business updates. NVIDIA Corp is leading a powerful new coalition of telecommunications leaders including Nokia, SoftBank and T-Mobile US to develop 6G phone networks designed specifically to support artificial intelligence. The tech giant argues that current 5G networks, which were built primarily for human data and voice transmission, lack of the capacity and efficiency to handle the sophisticated requirements of the AI era. By building 6G on a foundation of software and general-purpose computers, NVIDIA aims to create a platform where AI can manage radio traffic with exponentially higher efficiency than today's standards. The motivation behind this shift is the expected surge in physical AI, such as autonomous vehicles and humanoid robots, which will require wireless networks to deliver real-time intelligence to machines rather than just information to humans. Ronnie Vasishta, NVIDIA's head of telecommunications, notes that the networks of the future must be hundreds and thousands of times more efficient to compensate for the limited availability of radio spectrum. Without this evolution of wireless infrastructure, the widespread adoption of advanced AI technology could face significant delays. The networks of today simply aren't ready for the use cases of tomorrow, Vasishta stated, emphasizing that 6G will fundamentally change how intelligence is delivered across the globe. By advocating for open software-driven system over proprietary hardware, NVIDIA is also looking to lower the barriers in entry for new players. This transition is expected to spark innovation and competition within the telecommunications sector, potentially paving the way for a new generation of telecom unicorns and billion-dollar startups. Well, that's a wrap for Closing Bell Updates with me, Madhaveshwari. Thank you, investors. We shall catch up in the next session. Goodbye.